Welcome to Trading Nation. I'm Eric Chemi. Today we're pleased to be joined by Tony Dwyer, Chief Market Strategist at Canaccord Genuity. Tony, let's get right into it. You're out with a new note saying a quote, whoosh of uncertainty has created an opportunity for investors. Walk us through that call.
There's a couple of technical terms there. We've been looking, honestly,
technical
since
terms?
the middle of
Whoosh is the
right,
technical term.
Whoosh and ramps. We've been looking for. We're kind of in this. People keep trying to make this into a fundamental corrective period, and it really, there's a lot of excuses that are plausible for that. Remember, we started out with labor inflation on the January labor report in the first week. That created some selling, and then you had the short ETNs were the reason for the excessive weakness, and then it's tariffs of steel and the steel and aluminum tariffs, and now it's the trade wars. Ultimately, what it comes down to, Eric, is you had just a ridiculous level of bullishness after a 7.5% start to the year in just 3 weeks, and that created an environment historically where only 12% of investor newsletter writers, according to Investors Intelligence newsletter writers, were bearish. And when it's hit that level in the past, only 12%, it's a sign that you really have excessive optimism and you're going to correct. So we have been making the case that the first half of 2018 is going to be a very volatile year without a lot of progress, where you get a lot of whooshes, which means sharp, oh my God kind of sell-offs, and ramps, wow, we're going to new highs tomorrow, one of which is happening today. And our policy is we want to add to exposure as you get a whoosh, because the fundamental backdrop is terrific, and maybe just not try to chase some of the real ramps that we get.
2649 on the S&P right now. You've got a year-end target of 3,100. Is that right, according to my notes? Because that seems like a big move from right here.
Actually, I think I'm a little too conservative. I probably got to raise my numbers,
wow.
which I've said publicly. Listen, you know, here's what we had. We had people that are kind of giving up or calling for the peak based on it's 9 years into it. It's not done by calendar, it's done by credit, which is driven by Fed and the slope of the yield curve. So our view is that you've had a 10% drop as of Friday's close, and you're going to have 20% earnings growth this year. That's one heck of a multiple compression on forward numbers. So you'd really have to have a significantly negative move here economically relative to expectations into the end of the year to disappoint that number, because of the tax cuts and just the global recovery and what's happening in capital spending and consumption in the U.S. So if you go to the end of this year and have $155 in earnings, which is our expectation, you're only trading at 17 times that number. Now, you were trading at 19 to 20 times that number going into it. So we believe that you should, historically, when core inflation is between 1 and 3%, the market trades at a 19 multiple. So at a 17 multiple, you want to be a buyer of stocks.
That makes sense. What do you tell the bears, though? What do you tell the people that are looking at S&P 2500, let's say? What do you tell those guys?
Well, you really have to get, I mean, you could get S&P 2500. Historically, when you get into these volatile periods, you typically retest and break the lows. We retested it and haven't, you know, maybe marginally broke it a little bit. But, you know, 2588, that's pretty close to 2500. So if your downside risk is 2,500 and your upside is 3,100, when you get that kind of whoosh, as we started out the segment, that's when you want to be adding into it. It's obviously total fear. I think one of the issues that is in the marketplace is the Fed is raising rates and the yield curve is flattening. And some people take that as a negative. But let's get nuts, Eric, and just say, okay, the yield curve's going to invert tomorrow. Let's just say it happens tomorrow. We did a study that shows that if you invert the yield curve tomorrow from the initial date of inversion to the S&P 500 peak, to the peak of the cycle after that initial inversion, you get a median gain of 21.13% over the course of 18 and a half months. A recession begins a median 19 months later. So if you get even what the bears are worried about, which is an inversion of the yield curve, which is what drives recession expectations, you still have plus 20% over the course of almost 2 years. And if you weight that to just the last 3 cycles, it's more significant. It's longer in duration and higher of median gain.
Interesting. Tony, I just wanted to ask one last thing. What do you think is the biggest misconception in the market right now? From talking to your clients, other traders, other people out there in the industry, is there something that people seem to get tripped up on a lot?
Yeah, Eric, I really think it's that we chase price. I think what's happening is we keep chasing price. For example, when the bond market in the middle of last year, early part of 2017, when the 10-year note yield was at 2.06% or so, people were starting to talk about the one handle with disinflationary forces. Then we go up to 2.92%, and everybody's talking about 3.25% or north of 3% on inflationary forces. It's somewhere in the middle, and I just hope that the viewers can try and temper some of their enthusiasm when things are spiking and temper some of their fear when things appear to be tanking until you invert the yield curve, well after you invert the yield curve, because that's your sign of a recession. We can be making a peak. Heck, we just had a 12% peak to trough drop. If you look at the January 26th to the recent low, you've had that's a pretty good correction. You can have a correction. The correction, the peak in the market only comes following an inversion of the yield curve and a shutdown of top-line growth in a recession.
I like that. I'll have to take a look more closely at these inversion numbers and how that plays out. That's a really good insight for our audience there, Tony. Thanks for coming on Trading Nation with us.
It's my pleasure, Eric, and you can, of course, give us a call if you want to see it.
Of course. That's Tony Dwyer, Canaccord Genuity, Chief Market Strategist, who's on Trading Nation today. And thank you for watching. I'm Eric Chemi. We'll see you next time.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.